Hello, everybody, and welcome to episode 119 for the National Land Realty Podcast, where we discuss all things land. My name is Mac Christian, and I am the Chief Marketing Officer at National Land Realty and also the host for this podcast. Now, I want to make a couple special announcements before we jump in. We're moving into 2025 from 2024. So the first thing I want to say, in case you don't listen to any other episodes later in the year, is have a very Merry Christmas, Happy Holidays, everything that you do during this time of year. Hopefully it is about family and enjoying those that you love. So please enjoy the holidays, get out, get outside, enjoy the cold weather. I'm sporting somebody told me I looked like a mountain man the other day. If you're looking at this on YouTube, I'm rocking the beard, getting ready for some PTO at the end of the year here, and we'll be doing some skiing and some steelhead fishing up in the Northwest United States. So that'll be fantastic. So I just want to make a quick announcement to everybody just to enjoy your holidays. Not an announcement. That's not an announcement. The thing I do want to announce, though, is that we are going to be changing things around on the podcast a little bit here. We have been going fast and furious for about 2.5 years now of one episode a week we're going on 120 episodes now. And we're going to start pulling back on that a little bit because honestly, it's hard for everybody to keep up with a 1 hour podcast once a week. So we're going to go with probably a bi-weekly to three week, once every 3 weeks schedule, once every 2 weeks schedule, so that we can try to concentrate more on getting more and more quality content, getting more guests in front of you that matter, and providing more value to you. And giving us more time to do that and the planet is going to help that cause. So those things will change here in 2025 a little bit, but nothing else does. We move forward. We keep talking about land. Now, today is our special treat. This is something we do once a quarter, where we sit down with Jackson Takach, who is the chief economist and head of strategy, research, and analytics at Farmer Mac. In case you are not familiar with what Farmer Mac does, they're the secondary market for land loans or agricultural loans. Basically, what that means is if somebody gets a loan for land or agriculture, it originated with Farmer Mac. Now, they don't loan directly to people. They loan to the companies that loan to people. So that's how secondary markets function within the mortgage industry. Farmer Mac is the one that supplies the loans for agriculture. So when you want to talk about somebody who really, really, really understands agriculture and land values, it's Jackson Takach. And today we are sitting down to talk with him to put on our crystal ball. We're going to talk about a new administration coming into office and the conversations that administration has engaged in during the election cycle. We've already seen, we don't like to speculate. Jackson and I, both of us kind of sit on the same side for this. We don't like to speculate, but we have seen this administration before, and there were a lot of things discussed during the elections, and we're going to talk about what those might mean for agriculture. We're going to talk about the interest rates and what that might mean for land values and agriculture moving into 2025. And we're going to talk about the Farm Bill. Is it ever going to get done? So we're going to have those conversations and more. Now, please sit back and enjoy. Okay, so once again, for our quarterly update, I'm sitting here with Jackson Takach. And Jackson, I brief outline what you do, how you do it. I feel like this should be getting shorter and shorter as we go on, but I always got to bank on somebody listening for the first time.
Hey, no, I get it, Mac. Thanks for having me back. Jackson Takach, I'm the chief economist and vice president of strategy, research, and analytics over at Farmer Mac. If you're unfamiliar with Farmer Mac, we're a secondary market for ag mortgages, food supply chain lending, rural infrastructure lending, and a whole bunch of stuff. And really what that means is we don't have retail offices. Instead, we support lenders out there across the country. They make loans. They use our products and services, sell those loans to us. We can hold them, package them up, however it is. And we try to make capital more accessible, more available, and more speedily put out there into the marketplace for lenders, farmers, ranchers, rural Americans, coast to coast.
Yeah, I always like to summarize you there and be like, if you've ever had an agricultural loan, chances are it probably started with Farmer Mac and trickled down through the ecosystem to where you got your loan. So you all are the money supply for land and agriculture, and it's sort of the wheels behind that, and it's such a cool thing. So we get together like quarterly here and try to talk about what's happened over the last 3 months. We're meeting a little early this time to try to beat the holiday rush. And then we try to put the crystal ball on as far as what we see in the next 3 months, and sort of to give you landowners and possible landowners an idea of what the market is doing. And so, first thing I'm going to ask you, because obviously we just had the election since our last meeting, and there will be a new president taking over in the next year. And so I want to ask you sort of what you've seen market wise. Has the turmoil of the political season caused anything in the overall economy, or have things moved forward steadily? Is sort of where I wanted to position you on the question.
Well, it's a great place to start, Mac. And yeah, I last couple of times I've spoken to just different groups, I always say, like, is there something going on? Was there something that happened recently that we guys want to talk about? Even though I'm not a political commentator, right? Like, what happens in the policy realm for sure impacts all of our lives as business runners, operators, owners, investors, just being people, consumers, right? So that policy changes and changes at that political level can have pretty dramatic impacts as it trickles down from maybe where those decisions are being made and where laws are being passed and how that flows through the economy overall. So I won't talk about, maybe like one race or another race or what was again, that's kind of outside my area of expertise, but I can maybe comment a little bit more on what's going to happen with interest rates. How does this, how are the markets interpreting some of these things? And it has been, for lack of a better word, more volatile, right? I think we've seen some of the good sides of volatility, meaning financial markets have increased pretty steadily since the election. People, I think, are there's always a little bit of exuberance around a changeover in the political realm. We saw it in the Biden administration. We saw it in the first Trump administration, where people are kind of voting for change, and then the markets interpret change as possibly a good thing, right? Depending on, are we talking about stability? Are we talking about, like deregulation? What is it we're talking about? Why are we getting excited about it? And that volatility has kind of turned into a little bit of momentum for a lot of investors post-election. Now that can unwind a little bit. You see, volatility goes both ways, but right now I think a lot of that volatility has been positive, meaning markets are increasing ahead of year end. Not every market's the same, right? So we talk about interest rates, we talk about bond buying and yields, and I think that's been a bit of I think maybe volatility is a perfect word for that. We've seen yields go up and then come back down, and we've seen kind of a lot of trading around what's going on in the long term versus short term. So interest rates have been a bit of a choppy ride. So we switch from our focus in stock markets to investor bond markets. And there we've seen prices dip. People were selling bonds originally, and that drove yields up, and then lately they've kind of steadied out. So volatility is still a good word. It's just been a little bit more up and down, a little bit more choppy in the interest rate yield markets. The rest of the spectrum, we're data dependent, right? Economists love data. We want to see the data. It's trickling in, and so far, a lot of the data that's coming in about recent conditions has all been pretty positive. So a lot of momentum of the economy heading in to the end of 24, excited about some possibilities in 25. And generally, people are pretty positive right now about the state and condition of the U.S. economy, showing up in lots of ways. Consumers are spending a lot. I don't know if anybody went out after Thanksgiving holiday, did some shopping, but the parking lots where I was were full of people. Consumers feeling pretty good about their pocketbook. And that's, again, another tailwind to the U.S. economy.
There are still... There's a few rumbles out there of kind of recessionary hawks looking at our economy. Do you see any potential risk in just overall that would indicate possible weak areas for that?
Well, yeah, sure. There's, I traveled around the country. I spoke, I don't know, a couple, 30 times this year. Every time I went somewhere, I asked, what do you think? I talked about the dualities of the economy. In fact, we've talked about it on this podcast before. Just that feeling of like, things are good, things are bad. Which is it, right? And in reality, it's a lot of both. And in my travels, speaking to different groups across the country at different positions and different, backgrounds and in different industries, I saw more people sort of leaning towards the positive, but that means that there were still several people in the room would raise their hand when they said, hey, I think the economy's in trouble a little bit. They point to some weakening jobs numbers. They look at some layoffs in certain industries, particularly in technology and some white collar jobs, right? So there's been, certainly no shortage of dissenting data, but it's kind of one of those spectrum things, right? You've got this spectrum of data, and if a lot of it's pointing towards maybe positive economic growth, you tend to coalesce around growth. Now, you can always have a few pieces of data that maybe are pointing the other way, and that's where people are going to disagree and say, hey, I weight that piece of data better than that piece of data. I think that's more important for the future. So people are going to be right, some people are going to be wrong. That's the beauty of being an economist. It's kind of like being a meteorologist. It's okay if you're wrong. You just go back and say, well, things are different than what I thought. And yep, I was wrong this one, but I'll be right the next one. And everybody kind of gives you a wide berth on those kind of things. So when you're predicting the economy, yes, I'd say I think the majority of the data says, hey, things are pretty good. But there is, one or two or five or 10 economic indicators that say, hey, maybe things are slowing down. I'd point to the amount of debt that's accumulating at the consumer level as maybe one piece of evidence of a particularly sensitive economy. So when you get a lot of debt, it doesn't take much to sort of trip up the consumer. Maybe they stop spending for a couple of quarters as they pay down that debt or the interest starts to hit. Similarly, with fiscal debt, U.S. government and other governments, not just the United States, but globally, we've got a lot of debt. So there's a lot of sovereign debt out there, a lot of corporate debt out there, a lot of consumer debt out there. And that amount of leverage can create some issues down the road when some of those bills start to come due. You got to pay for that debt eventually, and that results in lower spending, right? So lower revenues because you're using the money to pay off interest or pay down debt, those kind of things. You got to pay that piper sometime, but we got to hope that the growth is fast enough to give people income to cover those debts down the road.
Yeah, the conversations that have been rumbling have been one, debt, two, equities, and I think those are the big ones that you hear about most often. Is at what point are equities being valued above what they're actually worth, and where does that fall, and how much debt is being accumulated in the meantime. The other one you spoke to is what I've heard it called everything from tech apocalypse to the white collar apocalypse, and it's been flagged as an economic indicator, and yep. I feel like that's ignoring a lot of history when people are talking about that, because we just got out of, what do they call it? It was the hiring wars. And I felt nervous the whole time when people were talking about the hiring wars. My wife works with employment data, and just talking it through how many people were hiring and what their roles were being hired for. And I kept on making the comment, like, these people are going to realize they've overhired at too high of an expense, at too many numbers, and there's going to be huge I don't want to call myself Nostradamus or anything, but I felt pretty slick about that one, because that's kind of, it does seem like that's what's happening, is people have gotten over leveraged in their employees and they've got to drop weight. Like, it's one of those things, like, it's not cool, but it's sort of what happens.
Yeah, it's the reality of that cycle of, sort of hiring and cutting, expansion and cutting. I think a lot of the cuts have been from industries and companies that had done quite well, right? And so they'd hired maybe up, and they were entering a period of less positive news for the industry. I mean, I'm thinking about, sort of Silicon Valley developers a few years ago. Hot commodity, everyone's working from home. We've got to hire. We can't get the right talent. Well, lo and behold, like, there were a lot of structural changes that happened in those industries in 22, 23, and into 24. Interest rate environment changes, investment thesis changes, the capital gets pulled out, and that changes the math on growth trajectories for a lot of those industries. Another one that's really interesting to follow, or in the ag space, some of the input providers, machinery providers. John Deere is one that gets a lot of press about their layoffs. I mean, it was gangbusters, right? You couldn't make enough tractors a couple years ago. All of a sudden, the ag economy looks to be a little bit on tilt. A lot of the investments already been made. And I think John Deere looked around and said, "Hey, we got to right size our if we don't do this now, by the time we've made too many tractors, it's too late, and we've got a bigger problem." So, I think companies have to adjust. They have to, look out for 1, 2, 3, 4 years into the future. Look at that demand curve for their product and do the right things to sort of right size their workforce to make sure that they've got the right people in the right places to meet the demand of the future. But it can be pretty painful to go through those things, particularly in small towns. Like if I grew up in a small town where the manufacturer, if they closed shop or maybe downsized, it could devastate a whole community because so many people relied on those jobs. So where those layoffs are happening, that can have a big delta in the economic outlook for those communities. Even as in big cities, right? When you talk about Silicon Valley, California, a lot of the workers maybe who experienced some of that techpocalypse which I'm not sure if that is a word, but it should trend tomorrow if it's not. Um, those communities were damaged. You look at the housing values, right? When people had to leave and sell, and a lot of houses come on the marketplace because those jobs have moved or been eliminated. I mean, it can have a pretty big impact on those communities. And that's even more true in rural areas where it could be a high percentage of the employment in a small town comes from one or two providers, right? And that can disrupt things pretty substantially. But I got to say, we need to be forward looking, and these companies are trying to be forward looking and meet the demands of the future. So it's a delicate balance of you don't want to disrupt communities, lifestyles, people's livelihoods, but the companies have to adapt and adjust to conditions as they're happening.
Yeah, and especially now with talking from the technology side, it yields itself in the rural side as well, but not as fast is when you have streaks like this where there are mass layoffs. You see a lot of small startups.
Yeah.
It does drive some disruption in different industries. It's harder in manufacturing because you're dependent on a manufacturing facility, and if that has layoffs, that's disastrous for a smaller town. So it just depends on sort of the area and how they're managing that. But economically, over the last 3 months, anything that I've looked at, and that's where I have to defer to you, things have looked steady, and if anything, indicating to not a high amount of growth, but growth that we've seen over the last 3 months. So the big question, the crystal ball question, is what's our anticipation over the next 3 months? And I do want to jump into. We talked briefly beforehand about like the farm bill and things like that. I want to jump into those too, but let's jump into the meat here. What do we think about economically, especially ag sector? What we can anticipate over the next 3 months?
Yeah, it's going to be, I think, a little bit dependent on sort of what happens out of the starting gate, right? Trump administration 2.0, what is it that they're going to focus on? What are the things that are going to sort of disrupt or change business expectations? I look at, we got a Fed meeting coming up, another one in January. And so, hey, I think the word of the day for some of these economic indicators is steady. So that means we got a decent shot at maybe another cut coming up in December or January, or maybe one in each. So I think some of that steadiness bleeds into interest rate policy that's relaxing. It's not going full on dove. We're not cutting back down to zero in any way, shape, or form, but relaxing. Hey, if inflation's steady, if we're seeing some of the pressure come out of that like high growth environment from a few years ago, we're seeing supply demand sort of equilibrium happening in lots of industries across the spectrum. That's good support for the Fed starting to let some of that pressure out. They put a lot of pressure in the financial sector by raising those interest rates, trying to slow economic activity down. 2 years later, you kind of like realize some of that slowness, right? As people rethink their investment strategies, where do I put my money? Do I invest it in the stock market or put in something short-term and safe? 4.5% in Fed funds, people are putting it in short-term and safe. So the economy's starting to slow down. Maybe it's not 5% growth, maybe it's 2.5. But I'll take 2.5 when I look at the rest of the world. The rest of the world looks kind of dicey. You go to Europe, things are not, they're slower economically than they are here. If you go to parts of Asia, we've got some wars breaking out in the Middle East and Ukraine and Russia continuing. So there's a lot of disruption happening globally. Not too many economies can boast a 2 to 3% growth rate. That's what we're looking at, 2 to 3% real growth over the next 6 to 12 months. Pretty solid footing to enter a new year on compared to the rest of the world. Do I think we're going to have a hyper growth era next year? I think that's probably unlikely. I think we're probably closer to that 2 to 4% growth range. I don't think we're going to 5 or 6. Even if you had a rapid change in regulatory environment, which has been proposed, or a rapid change in trade policy. Some of these tariffs that have been proposed, maybe you see a lot of investment coming back into manufacturing in the United States. All of that stuff takes a lot of time to take effect. So what we're going to experience over the next 3 months has kind of already been baked into the cake by the last 2 years of policies. And it's kind of indicating steady growth, healthy, generally healthy economic activity with a few pockets of maybe some stress. And I'll say the ag sector is probably one of those pockets where we've got a little bit more stress, coming off of great years, a lot of cash buildup. We talked about this last go round. But lower commodity prices, lower revenues. I mean, that's hitting home. And there's only so many years after those good years that you can survive leaner years before you start to feel the pain. And maybe farmers are starting to see the next group that are cutting back a little bit, and not companies who put machinery in farmers' hands.
So some of the thing, any of us, I'm in the same boat as you. I don't want to jump into the political realm. Some of the conversation points, though, around the election cycle have revolved around a couple of different things. And you mentioned tariffs.
Yep.
In situations in the past, we've seen when tariffs are imposed, we've seen counter tariffs. But trying to anticipate what those are going to be, I think, is up in the air. In the past, it's been like pork and steel, right? Or like two of the big ones that have been there. The ones that could impact us are going to be fuel, meaning going into fertilizer cost or something like that. And that doesn't even play a role that I know of. I'm just trying to think as far as that could be. Soy could be a high impact area based on trading partner, because we've looked at tariffs with China. Like that could impact some of our trade value. But then it's been said, if we experience counter tariff, there's other places to sell and expand into. Sort of a fluid market moving forward. The tariff conversation is really perspective. That one we don't really know. The other one that's been discussed widely is immigration, right? Where we've looked at like agriculture incorporates a lot of migrant workforce. And those two things appear to be the strongest maybe influencers over the next few months. But I don't see those playing a huge role in the first year. I always like to joke that the first year is on the previous administration. It's that year 2 and 3 and 4 that really you see a lot of impact. I was curious, like, what's sort of your sort of outlook on those sort of policies that have been talked about? Because we don't even know if they're going to come into play yet. Like, we just don't know yet. But if, I guess.
Yeah, no, I think playing the what if game is actually okay in this situation. Normally, I'm like, well, I don't like to work in hypotheticals, Mac. Like, let's keep it strict. But this is one of those cases where enough has been talked about on the campaign trail, and we have a pretty good track record understanding of sort of what a Trump administration values, what tools do they pull out of the toolbox, that you can have a pretty good guess, like high probability of guess of like what are some of the chess pieces going to be doing over the next 3 months. I totally agree with you. I think trade, immigration are going to be two of the hottest issues that we talk about, in addition to the Farm Bill, in the next 12 to 24 months. There is absolutely a lag on all of those things, right? You don't just like flip a switch and all of a sudden, the entire market's different. It takes a long time to draw, it's like one of those butterfly effects, right? You make a change here, a butterfly flaps its wings differently, and all of a sudden there's an earthquake in Indonesia somewhere. So for sure, there's a long lead time here. I look at the trade thing, I go back to 2017, 2018, even into 2019. China doesn't even have to put on retaliatory tariffs in order to make an impact. That's one way that can happen. A lot of other countries will play by that playbook, which is a tit for tat. You tariff me, I tariff you, and then we both lose. Our markets both lose. And hopefully we negotiate a better outcome overall in the end. Because China has so much control over its buying practices, they can just not buy from America, right? They don't even have to put a tariff on it. They can largely just say, we're going to now shift all of our purchasing power into Brazil. That's what happened in 2017, 2018 timeframe. We saw the North America stocks of soybeans go up and up and up, meaning supply is increasing. And in Brazil, decreasing. And there was this decoupling of world price. The price in Brazil for soybeans went sky high. The price for soybeans in the United States hit the floor, right? And typically that doesn't happen when you have sort of open trade, free uninterrupted trade, there's a one world price and everything kind of normalizes based off of global supply and demand. 2017, that didn't happen. 2018, it didn't happen. So we end up getting maybe a little bit out of whack globally in price. And who's the worst impacted? It's United States farmers, right? Because all of a sudden, world price maybe 13 bucks a bushel, but the U.S. price is 8, right? And then we sort of had this dichotomy between the prices in different regions because China says, "Hey, we're going to buy from Brazil to cause a little bit of disruption and political pain. Hey, you're tariffing our stuff, no problem. We can buy elsewhere," and that's their way of being able to do that. The other sort of soft way that I've seen, not just China, but other exporters influence policy without putting in a tariff. So not the tit for tat, which is certainly one thing I expect to see over the next 12 months if some of these tariffs come into play. The other thing is to disrupt the supply chain, right? So if I'm a maker of a component that someone in America needs for their manufacturing process, I can delay that sale. I cannot take that sale. There's things that I can do to disrupt the flow of economic activity. And because the U.S. economy is really reliant on a lot of those different supply chain mechanisms globally, a disruption in one of them creates a big problem when you try to put all the pieces together, maybe here in the United States. So I think there's really two ways outside of that tit for tat, counter tariff a way that economies can mess with U.S. economic activity. The ag sector is probably going to take a little bit of the weight of this because so much of our ag product gets exported. We're top 3 trade partners in food and ag: Canada, Mexico, China. And already, President Trump is starting to poke those bears and say, "Hey, we're going to open up negotiations. These are the things that I want. This is what we're going to do." Not even having assumed office yet, right? Just still president-elect and tweeting out these things to our top 3 ag trading partners. So for sure, I think ag's going to be in the mix. What happened 5-6 years ago? We got a lot of support, right? So government support, market facilitation programs bled into COVID support. So farmers were made whole in many cases by some of that support. But I don't know too many people who like to live off government support, right? That's not the, I think, preferred source of income for farm businesses. They tend to like markets to act. And so I think we're in for a little bit of, disruption. We'll figure out what happens to the trade and tariff policies in the next couple of months. We'll see. New Trump administration comes in. Maybe it's more rhetoric than action. Maybe it's all action. When we find that out, I think we'll kind of learn how people are going to respond. I'm watching China. I'm watching the strength of the dollar, and I'm watching Canada and Mexico to see how they respond today to tell me maybe what happens here in a couple months.
I find the phrase getting repeated all the time. It's going to be interesting.
Yeah. What's that the old curse? May you live in interesting times. A proverb curse. I'm not sure what advice.
Yeah. Well, and it's because anything that we're talking about, right? Like China, their reaction to not buying soy. That's what happened in the past. We don't know if that's going to and as far as the tariff conversation, it could be something different. It could be, it could be steel. It could be, concrete imports. I don't know. I'm just, whatever it is, it could be something, if there's anything, or is it all sort of talking now in order to get them to go to the negotiating table in a few months? We just don't know.
Well, that's right. And I'll also point out, we don't know how people have been preparing for this possibility, right? So has there already been some chess being played by parties outside of the U.S. with the thought that, there could be a Trump administration 2.0? And so I think the first administration caught people a little bit off guard. There could be some of that, surprise factor that happened in 2016 to 2020. But I think some of those playbooks maybe have been exposed, and the people that we're playing against on the other side of the chessboard now have seen some of those moves before. So it'll be harder on both sides, right? We've seen how, maybe Chinese officials react to policy implications. They've seen how we propose policy under this administration. And now that we both are smarter and know how each other like to negotiate or play the game, it could lead to dramatically different moves, like you suggest, Mac.
Yeah, absolutely. And so here, the last thing I want to hit you with is the the longest discussion that I can remember on a bill. The farm bill. What are we looking at here?
I think there's been a few longer. I was talking to our legislative affairs guy about this recently, and I said, hey, what's the record? Like, how many CRs? Like, how many times can you roll it before you kind of like enter new territory? And he's like, we're not even close, right? There have been years where you've kicked well past 2 years. I think the Senate released their version of the Farm Bill a couple weeks ago. I think that was a positive move to sort of get people talking again. But when you look at political motivation, right? What is the motivation for people to try to get a deal negotiated, a farm bill negotiated ahead of recess and a new Congress versus just doing a sort of 1 year extension and figuring it out next year when the Republican Party kind of has greater control over the political process because they'll have House, Senate, and White House kind of all under one color. It's tough to see the motivation to try to get something done this year. Not to say it's not possible. I think there are people working really hard to try to get something done. But I think it's a challenge to get everyone motivated to do something in it's like the clock's ticking on 2024. And the Farm Bill authorization runs out at the end of the year, right? So we got to get something done. Much easier to get a kick the can approach rather than a consolidated and negotiated piece of legislation between the two houses. That's how I'll say, there's a chance that it could get done this year in 24. If you're watching this already in 25, you'll know. You're in the future, right? So you'll know whether or not it gets done. I think there's motivation to get it done. You look at all the costs associated with farming, they're increasing. We haven't touched really the reference prices. So there's a lot of things in there to help the farm safety net, to help market stability, take out some of the more outdated pieces and bring in new pieces that help support farming operations. So I think the will is there, but there were a few, I think, sticking points between the Senate and the House. I mean, I say sticking points. They were pretty far apart in terms of design and structure. Bringing them all together next year, I think they should be able to do, but it's also a tax bill year, right? So reauthorization of the Tax Cuts and Jobs Act. Some of those tax provisions are sunsetting and trying to get, maybe big pieces of legislation done in addition to that tax bill that I think many Republican lawmakers are eyeing. That could be conflicting, right? To have all those different pieces trying to be plugged in at once. So it could get a little congested. Maybe that's my negative case for getting a farm bill early in 25. We'll get a little congestion going on and all the stuff that a new Congress wants to get done. But I think there's a lot of motivation to get something going and to modernize some of the things. The cost of farming is dramatically different than it was when the last farm bill was authorized. And I think everybody recognizes that and wants to get something more updated, more modern for farmers, and the whole farm ecosystem. It's not just farmers in that farm bill, right? It's consumers who, need food programs. There's a credit act, there's insurance. I mean, there's a lot in the food supply chain impacted by that farm bill. And I think everybody's motivated to put something smart together that's going to really enhance and support the food and farm system.
I feel like you're a lot more optimistic than me on this one. I've felt like with this one, it's felt like whenever you introduce a wide sweeping bill, you're never going to please everybody, and
that's right.
There's going to be one or two pieces that just tick everybody off, and you probably don't even see it when you're putting the bill together, but it's going to come to surface after you pass it. And it's one of those where I think everybody has been just playing hot potato. Like no one wants to get stuck with that potato when it lands, right? Like it's going to burn. And so it's felt like, like especially with an election coming up, it's like, well,
right.
We'll let the next one fall on that one. It might be us, it might be somebody else. So
I'm with you there. I think that was, again, just kind of driving around the country and talking to different groups. What I would tell people is, it's unlikely to get done in 24 just because of the election cycle, right? Everybody's going to hold out for what's going to happen, who's going to have control, who's going to have more authorizing, power, and can sort of write the bill they want to write. The Senate didn't release their bill until November. So, I mean, that in and of itself said if the Senate's not releasing their bill for public read, they're probably not super serious about passing a farm bill in 24, right? So that to me, I was just watching that until the Senate released a version. It was kind of like, I doubt it, right? I doubt it. They put out a version. I thought, hey, maybe there's a shot to get something going. But it's just, they're in pretty different spaces, right? The House bill versus the Senate bill. And there's a lot of work to bring them together. And you just start looking at the clock going, it's hard. There's less motivation to get it done. There's a path to not doing it, right? When you can just extend the existing farm bill. And what is that, what's the most likely outcome there is, okay, we extend time for another year. And now we're talking about the 25 farm bill or the 26 farm bill. And I think that's way more likely. A 25 farm bill is way more likely than 24. And I'm betting, 26 will get something done before 2026, right? Like it may be a 2026 farm bill, but we're not getting to 27 or, we're not going to skip a decade of farm bill legislation. I think we'll get something done in the next 12 to 18 months.
Yeah, what you were saying about tax code stuff that probably will take priority over anything agriculturally related, and but the other hand of the other side of that is kind of what you brought up is if you have a politically aligned House and Senate and White House, you have a quicker path to completion on a lot of things. There's a lot of less of that back and forth. So maybe, I don't know, we're playing crystal ball time now. Who knows? So
that's right. That's right. Caveat: anything could be wrong and anything could be right, and it's still a great conversation.
Exactly.
The margins are still so narrow. I mean, it is a very divided legislature. So even when you get that alignment where, so one party is in control of both houses of Congress and the White House, it can still be hard to do things as evidenced by 2021 and 2022. The Biden administration had an aligned congressional and White House, right? So all blue all the time. And it was still difficult to get things all the way through because there's different corners of the party. And there's also, kind of folks positioned in the middle. And I think that's still true today. So I wouldn't expect it to just be, hey, open shoots, everything just flows all the way through. There's still going to be quite a bit of debate and dissent on anything just because of those narrow margins. But one thing I'll say about farmers is they are a friend to the American politician. Nobody wants the American public to be hungry. I think that's the worst thing you can do, as we saw in several Middle Eastern countries in the last decade. When people get hungry, they vote for change or revolt, right? Revolution comes out of a necessity and dissent. So I think there's a lot of motivation to keep farms producing food at reasonable costs. And so, the farmer is a pretty good ally to have. And therefore, they tend to get a lot of support when we think about what's important to the American public, keeping them fed, educated, heating, energy, defense, right? All those things tend to get a lot of support and not a lot of dissent. Maybe how you do it, people will dissent, argue, and debate. But say supporting the food system, it's a pretty easy thing to get behind if you're a lawmaker because, hey, people in my one thing that unites us all is we all eat, right? If I had to pick one thing, maybe it's breathing is the other thing. You gotta breathe.
Yeah,
you gotta drink water, and you gotta eat.
But yeah.
So it's a unifying. If we had to all come together, right? It doesn't matter what your political leanings are. We can all get together around the kitchen table and enjoy the beautiful bounty of food that we produce in this country.
Agreed. Got a couple minutes left. Anything else to highlight sort of economically that you've had discussions on lately that we haven't covered?
No, I think, the interest rate environment is something that we're obviously at Farmer Mac keeping a close eye on. Our loan products in the long-term space, we do a lot of long-term products. So like a 30-year fixed rate farm mortgage, very akin to like a 30-year fixed rate residential mortgage, kind of fluctuating. I think everyone expected Fed cut rates. So that means you're going to cut rates too, right? And some of that is out of everyone's control, right? The long-term part of the yield curve is controlled by people buying and selling bonds, right? It's not about the Fed. It's not about Farmer Mac. It's not about the bank. It's about the markets and how they're interpreting risk. So we saw a big drop in those long-term rates, and they kind of bounced back up a little bit. But I think what farmers and ranchers are kind of watching and land investors are kind of watching is like, hey, are we trading in the right direction? Are we seeing rates come down? And the answer to that is absolutely. A lot of the risk in lending has started to ring itself out in terms of interest rate risk. So even though maybe we've seen a bit of a sort of a bounce in those long-term rates, because things are a bit more settled, they're compressing relative to other rates. So yes, it may look like, hey, my 30-year fix has gone up a little bit, but relative to like a 10-year treasury, it's actually looking pretty good, right? Compared to where we were 12 months ago, 24 months ago, when we were peaking out at 8.5%, 9% interest rates. That was pretty scary for a lot of people. Now we're kind of in those sixes, and that feels a lot more doable for maybe first-time farm buyers or first-time home buyers. Seeing some of that good signs of settling in those long-term interest rates, which is a great thing. Because some folks, is trying to come up on those reset dates. Maybe they had a loan that was fixed for a certain period of time, and now it's resetting to something higher. Well, hey, take a look at some of those products that we got out there today, that your bank's got out there today, because you may be able to roll that resetting product into something a little bit longer, save some money, set some of that interest rate risk up for success in the future, and not be as interest rate risk reliant, right? That's what we don't want to see, is people who see those wild swings in their interest expense from year to year. Getting that fixed rate, locking in some of those interest costs, I think that's an important part of risk management, and we've got another shot to do more of that in 2025.
Excellent. Well, Jackson, as always, it's awesome talking to you. It's good getting together, and enjoy your holidays.
Hey, thanks. Same to you, Mac. We'll see you in 2025. And some of the stuff we talked about is going to be right. Some of the stuff is going to be right.
We could hit something.
Techpocalypse is that's what I'm taking away. That's hashtag
Techpocalypse.
Thanks again, Mac.
Yeah, take care. This concludes episode 119 for the National Land Realty Podcast. Once again, we're closing out the year here. I want to give a sincere thanks to everybody that listens to this podcast. Very much appreciate your time. Please do your part and share this podcast. We can't keep it going if people don't listen. So please make sure to share this on your social media, share it with your friends and family, get the word out there. And very much a thank you to Jackson Takach, Chief Economist and Head of Strategy, Research, and Analytics at Farmer Mac, for a absolutely fantastic conversation. Enjoy your holidays. Thank you.